While global investors fight their way through the tangled briar of US rate predictions, Europe's bondholders should be swaddled in bucolic bliss. Regional economic indicators all point to a further spell of low inflation and more power to the great bull market in European bonds. European Union figures released on Wednesday revealed that inflation across the Eurozone has all but evaporated, with consumer prices up by just 0.1% on last year. Longer term, as we can see in our chart, the influential gauge measuring market expectations of inflation in 5 years' time over 5 years is 1.7%, well below the ECB's target of close to 2%. What's more, the European Central Bank appears poised to expand its huge €1.1 trillion bond buying programme beyond September 2016 if recovery does not pick up. So why isn't appetite for European debt stronger? Hints about full-blown quantitative easing last year were enough to spark a prolonged rally in bond yields across Europe. This time around, reaction has been far more muted. This week, Europe's largest and safest borrower has experienced a sell-off that has pushed the yield on Germany's benchmark 10-year bond yield up 12 basis points to 0.78%, as we can see in our chart. Berlin's attempt to raise €2 billion of 30-year debt on Wednesday also failed to attract enough bids, meaning that the auction failed. It could be that the sudden rush of Eurozone bond supply after the summer lull has left investors sated. But the price moves also suggest that the creep of US Federal Reserve influence has stretched across the Atlantic. The futures market still puts the probability of a Fed rate rise this week at just 30%. But Eurozone investors are alive to the fact that a surprise hike could jerk down prices in US and global bond markets. The lesson of recent sudden sell-offs in bond markets suggests that it is easier to get into positions than get out of them, thanks to waning liquidity. Europe's investors may be more interested in Draghi than in Yellen, but until US policymakers announce their decision, European bond investors are sitting on their hands.